If you've been following our series, you know how to generate income with covered calls, run the wheel strategy, and even buy insurance for your portfolio with protected puts. These strategies are great when you have a directional view you're a little bullish or you're worried about a crash. But what do you do when you look at the market and have absolutely no idea where it's going next? What if your strongest feeling is that not much is going to happen? Most investors just sit on the sidelines and wait. But there's an advanced options strategy designed specifically for this moment. It's called the Iron Condor. An Iron Condor is a strategy that lets you profit when a stock or index trades in a narrow range, when volatility is high, and when you believe a big move is unlikely. It sounds like the holy grail for traders, making money from a boring, sideways market. But it comes with a unique and severe set of risks. In this video, we're going to break down the Iron Condor from the ground up. We'll build one live with real numbers on the S&P 500, show you the exact math of the profit and loss, and deliver the brutal truth about why this strategy, while simple on paper, is one of the most psychologically challenging and potentially dangerous for beginners. Let's get started. To understand the Iron Condor, you first have to understand its core philosophy: selling volatility and collecting premium. The whole strategy is built on the belief that the implied volatility in the options market is higher than the actual volatility that will really happen. You are essentially acting as a volatility insurance company. Your goal is for the stock to stay within a specific price range so that all the insurance you sold expires worthless and you keep the cash. The Iron Condor itself is constructed by combining two simpler strategies: a bull put spread and a bear call spread. This creates a position with 4 different options contracts: a short call, a higher long call, a short put, and an even lower long put. This structure creates a profit zone between the 2 short strikes. If the price stays in that zone until expiration, you keep all the premium you collected upfront. If it moves outside that zone, your losses are strictly limited by the long options you bought. That's why they call it iron, as an ironclad risk protection. Let's build one together. Our underlying asset will be the SPY ETF, which tracks the S&P 500. Let's say SPY is currently trading at $500. We believe it will stay relatively calm, trapped somewhere between 490 and 510 over the next 45 days. So, we decide to sell an Iron Condor. Here are the 4 legs of the trade, all executed at the same time. On the put side, the lower half of the Condor, we sell one for $190 strike put and we buy one for $185 strike put. This is our bull put spread. We collect a net premium for this, let's say $1. On the call side, the upper half, we sell one $510 strike call and we buy one $515 strike call. This is our bear call spread. We also collect a net premium for this spread, let's say 80 cents. So, the total net credit we receive into our account is $1.80 per share. Since each options contract controls 100 shares, we collect $180 immediately. This is our maximum potential profit on the trade. Now, what about our risk? The width of each spread is $5. That's the difference between $490 and $485 on the put side, and $515 and $510 on the call side. Our maximum risk on the trade is the width of the spread minus the credit we received. So, $5 minus our $1.80 credit equals $3.20 per share, or $320 maximum loss per contract. This maximum loss happens if SPY closes above 515 or below 485 at expiration. Now, let's look at the 3 possible scenarios when the options expire. Scenario 1 is the win. SPY closes at 505, right in the middle of our short strikes. All 4 options expire worthless. We keep the entire $180 premium. This is the goal. Scenario 2 is a moderate loss. SPY rallies to 512. This is above our short call strike of 510, but it's still below our protective long call at 515. Our put spread expires worthless, but we are losing money on the call spread. Our loss is the amount by which SPY went past our short call, reduced by the initial credit we took in. The math can get a little tricky, but the important point is that we are losing, but our long call at 515 stops the bleeding. Our final loss will be less than our maximum of $320. Scenario 3 is the maximum loss. SPY either crashes down to 480 or explodes up to 520. In either case, one of our spreads is fully in the money. If SPY is at 480, our short for 90 put is $10 in the money, but our long for 85 put is $5 in the money. Our net loss is the $5 spread width minus the $1.80 credit we collected. We lose $3.20 per share, which is $320. This is our defined, ironclad maximum risk. This all sounds so clean, mathematical, and controlled. So why is the Iron Condor so treacherous? Let's go through the brutal honesty checklist. Risk number 1 is the high probability of a small win versus the low probability of a total loss. You might win $180 on 10 trades in a row, feeling like an absolute genius. But that 11th trade, where the market makes a sudden, violent move, can wipe out all 10 of those wins and then some. It's a strategy that can slowly bleed you dry with small losses before delivering one catastrophic blow. Risk number 2 is pin risk and assignment. If SPY closes at $510.01, your short call is in the money by just 1 cent. You could get assigned and have to deliver shares you don't own, creating a nasty short stock position over the weekend that you have to deal with on Monday morning. Risk number 3 is the worst of all, the whipsaw. The market drops violently, triggering your stop loss or max pain point, so you close the trade for a big loss. Then, it immediately reverses and finishes right back inside your original profit zone. You took the maximum loss on a trade that would have been a winner if you just held on. The psychological toll of this is immense. Risk number 4 is that it's capital intensive and often offers poor returns on the capital at risk. To trade one Iron Condor on SPY, your broker will hold collateral equal to your maximum loss, in our example, $320. But they might require even more for margin. Earning $180 on $320 of risked capital is a 56% return on risk, which sounds fantastic, but that's only if you win. When you factor in the probability of a loss and how often you trade, the annualized return on your total account can be very modest. So, should a beginner ever trade an Iron Condor? Here is your non-negotiable checklist. 1. Only use it on broad, liquid ETFs like SPY, QQQ, or IWM. Never on individual stocks that are prone to huge price gaps after an earnings report. 2. Only trade it when implied volatility is high. Selling premium when volatility is low is like selling cheap insurance. The money you collect isn't worth the risk you're retaking. You need that volatility premium to be rich. 3. Have a strict, predefined exit plan for both a loss and a win. Most professionals close the trade for a 50% profit or a 200% loss of the initial credit long before expiration, just to manage risk. 4. Understand that this is an active, high-monitoring strategy. It is not set at 10, forget it. 5. Only allocate a tiny percentage of your portfolio to this strategy. It is for generating a little bit of extra income, not for building massive wealth. To quickly recap, an Iron Condor is a non-directional, premium collecting strategy designed to profit from low volatility and time decay. You sell both a put spread and a call spread to collect a net credit. Your maximum profit is that credit, which you get if the stock stays between your short strikes. Your maximum loss is capped and defined from the start. The strategy's allure is profiting from a quiet market. Its curse is that truly quiet markets are rare, and the occasional explosion can wipe out months of careful gains. It is a tool for the disciplined, experienced, and emotionally detached trader who understands probabilities and risk management at a deep level. For a beginner, it is a fascinating strategy to study and paper trade, but it should be approached with extreme caution in a live account. Next time, we will demystify the engine behind all these option prices. We're talking about the Greeks, delta, gamma, theta, and vega. We lines explain them in plain English so you can finally understand what is really moving your options trades. Until then, trade carefully. Thanks for watching.